Hello and welcome to a very special edition of our Market Town Hall. 2024 is wrapping up and it is stock-taking time. While the Nifty is up only 11% this year, the mid-cap and small-cap indices are up an impressive 27% each this year. And while we take stock in terms of winners and losers, this is also the time to think ahead into 2025 and maybe even beyond. I'm Prashant, and that's what we intend to do here. With me is my colleague, Nigel D'Souza. Nigel, hi.
Well, thanks a lot for that, Prashant. Well, we have three very, very special guests joining us on the show to help us out with exactly that. The bets, the ideas you need to track, which will make you money in 2025. Let's welcome to the show. We have Niket Shah of Motilal Oswal, Taher Badshah of Invesco, and Rohit Shimpi of SBI Mutual Fund. Well, welcome, gentlemen. Thanks a lot for joining in.
Thank you.
Just wanted to also add that all the three gentlemen have managed what has turned out to be some of the best performing funds in 2024. So good on you all. Congratulations. And 2025, well, you'll have your work cut out.
Well, it's a full-on starcast here.
Indeed.
And we intend to use it to your advantage. So, what we intend to do here is pretty simple. Keep it tight, simple. We'll go one round with all of them to understand their sort of mental makeup as we head into 2025. Just a top-down view about whether the market is going to be easy, adversarial, or not. And then, of course, we intend to dive straight into the ideas which, of course, are going to be important, and the themes where they want to put money behind and which you should pay attention to as well. I also want to mention we've got a full audience here, and some of the brightest minds from some of the top colleges here in Mumbai, and we intend to open the floor up for questions to the three market masters with us. So once again, welcome to the program. Thank you very much, all of you.
Thank you.
So as I said, Niket, let me start with you. Top down. It's never easy, so I don't want to say, well, 2024 was easy and maybe 2025 won't be. It's never easy. But how is the setup looking as we head into 2025? As I said, mid and small cap indices have done 27%, which means stocks have done far better. Go on.
Yeah, so I think if you look at in the beginning of 24, it looked like a year where there were still some opportunities available today. But as we start 2025, if you look at micro and macro both, so if you look at micro, earnings growth is kind of weakening out. From almost 35-36% earnings growth in mid-cap that we have seen in the last 4 years, we are now down to about 4 to 5%. We don't expect this to meaningfully move up, at least for 25 as such. On the macro side, I think clearly there are challenges as far as US is concerned. US has clearly articulated that there's going to be a $2 trillion cut on spending. And one really needs to see how that really shapes up as well, because that can have a meaningful impact on global markets. So if you look at the macro and micro, it looks like 2025 will be much more tougher year, probably in the last 5 years. It will be a year where the market will be quite narrow. You need to really be very, very sharp in terms of your stock picking. You will not see a broader market that you have seen in 2020 to 2024. There will be few stocks doing very well, few sectors doing very well. And hence, I think one really has to do a lot of cherry picking to really do very well in 2025.
Okay, interesting. Well, Taher, what about you? What's on your wish list for 2025? Consumption clearly was a little bit slow towards the end of this year, that's 2024. Private spend as well was a little bit lower. So what's on your wish list for 2025?
Yeah, pretty much what has not happened in 2024 is what we should expect to happen in 2025. And, there are a few things which probably did not pan out the way we would have expected. For example, interest rates, in India, despite the fact that we've had interest rate cuts in the US, we've not been able to follow through. It's been about 4 to 5 months since then. And it's been a very long pause in any case. So I think that is something which probably we will look forward to happening in the course of the next year. Hopefully at the start of the year when we get some data around inflation as well as food inflation in particular, maybe the outcome on the summer as well as the winter crops. I think that should probably indicate whether we are headed for a phase where we can open up the doors for interest rate cuts eventually to happen in India. So I think that's one that we would probably kind of anticipate. The other thing is that we've also seen that very distinct deviation between in the whole consumption segment, where we've seen the upper end of the consumption segment do exceedingly well, whereas value consumption actually has trailed. And I think that is something which probably deserves a catch-up. Once again, it will be a function of what happens to interest rates, what happens to inflation, what happens to rural incomes. I think there are certain reasons which make us believe that that will get stronger, especially given that states and the government are now focused on rural upliftment, and probably also supporting some of the stressed sections of society. So I think that is another hope that probably comes about. It will give a more balanced look to the economy as a whole. And the last but not the least is probably private capex. That's also something which has been on the cards for a long period of time, especially at the time when we are probably confronted with a slower trajectory of government capex. We don't want it to slip significantly either, but private capex could probably come to the rescue. We've seen some initial signs. If you go by probably the a bottom-up assessment of the BSE 500, then the first half probably indicates that the capex for BSE 500 is actually up 15% year on year. And BSE 500 typically still comprises of a lot of the private sector companies, right? And within which, again, the government side is actually slowed. So actually what it implies is that the private part has actually grown even higher than 15%.
This is for what period?
This is the first half of FY25 compared to FY24.
Okay.
So I think...
But tying all of this together, as Niket said, would you agree this is going to be a far challenging year? I mean, as things are, I mean, if something comes to the rescue, so be it. But as they are right now?
So there are some of these things which are imponderables, and therefore we need to see as to how they manifest. I would like to think that the first few months of the year is going to be a bit of a weak start to calendar year 25. It'll also probably be a bit driven by global circumstances. So we have the US markets actually, or the developed markets in general, doing a little better than India. We have a earnings revision, upward revision trend out there in the US, whereas we have probably a downward revision trend, earnings revision trend out here in India. So I think that will play its role in the first few months of the year. Probably in the second half of the year, I would expect that some of the local factors play out. And by which time actually Trump assumes office, and some of the rubber hits the road with regard to some of the policies that will come about. So, I hope so too. And that probably brings about a rotation.
So we'll come back to some of these points, and I think that's well explained. Rohit, come in. First thoughts. Sure. I mean, adversarial, not easy. So let's keep that aside. But what's your sense?
So on markets, I think the way SBIMF in our equity strategy framework, we look really at three parameters, which is valuations, earnings, and sentiment, right? So when you start off with valuations, now clearly when you just look at the trailing PE ratios, even if you adjust for earnings cyclicality, those are at elevated levels, right? I think it's only when you adjust for the level of interest rates that those ratios are more in middle or median kind of territory. So that's okay as a starting point. It's not the best where you would want to be, but it's not too bad either, considering where interest rates are. So that gives you your asset allocation type perspective as well. When you look at valuation, when you look at earnings, actually, that has been a super bright spot in the last few years post-COVID, and we're currently actually going through some probably mid-upcycle pangs, to say the least, considering how the last couple of quarters have been for the overall market. And even excluding those one-off type stocks or one-off type sectors, we know them, the OMCs, the metal stocks, etc. Even considering that, taking that out, earnings have not been very great over the last couple of quarters. We do think that is kind of pulled down by two factors. One is the monsoon issues, some of the election-related slowdown that we've seen. And we are actually hopeful that that comes back over the next few quarters. Typically, a capex upcycle or an earnings upcycle does not fizzle out as soon as we're probably seeing market experts predict at this point. So I think that's a little more durable theme that we're hopeful on. And the third one is sentiment, right? And you can't exactly predict markets, but you can tell the temperature of the room you're sitting in. And clearly for the last few years, last few quarters, markets have been kind of hot, right? If you look at retail investor sentiment or subscriptions in IPOs, etc., that gives us some sense. So sentiment is off peaks right now, considering the fall we did see in markets back in, if I just look at October, November, for example. But on balance, I think, with valuations being middling relative to interest rates, with earnings seeing some pause, maybe they pick up, over a few quarters, and sentiment still being a bit elevated, probably the market outlook over the next few quarters, next few years is going to have to track how the earnings trajectory behaves. And there we're not as negative. We think that over a few quarters, over a few years, that will tend to pick up in line with the overall, capex cycle kind of coming back.
I just want to ask one local and one global question. So maybe a yes or a no, but maybe not yes or no, maybe two lines, but quick ones. How critical is the government spending and interest rates both to work for markets to do well in 2025? And from a market perspective, are we at that point that we need those to move in the right direction? More government spending and lower interest rates. Niket.
So I think, yes, we do need that. Government spending was down almost 28% for the first half of the year. We expect that to pick up in the second half, but it's still going to be missing targets for the year.
Okay.
So definitely government spend would be quite important if you want to ensure that the animal spirits of the economy continues to remain alive.
Sure.
On interest rate, I don't think inflation is coming down anytime soon. You look at the amount of freebies that has been given in the election in different states. It's been about close to 2 lakh crores. A lot of people don't realize it's 2.5 times Manrega outflow, right? And that is ensuring that the inflation on the food side continues to remain fairly high. You look at the last number that RBI reported, about 9% food inflation. When you have a 9-10% food inflation, core inflation continues to remain quite sticky yet. I don't think we are going to see an interest.
So rates will remain high, government spending must come back. Taher?
I would tend to agree. So basically, we need government capex definitely to continue, and I think that is the core of the Indian economy, at least.
You mentioned private sector has to pick up the slack, but we've been hearing that for a while. It's not. I mean, maybe it'll happen. Hopefully,
some signs. So
the government
some
has
data
to.
which is corroborating. So I think government has to, and it in up cycles of investment cycle, rising investment cycles, government has always played a very important role. They occupy nearly about 70% of the capex that has to be done. So obviously, you can't have a situation where they are absent from the market. All I'm trying to say is that probably if you are seeing a little bit of slowdown on one side, if there is a pickup on the other, then we probably are balanced out. So that's what we're looking forward to. There are some telltale signs, there are some hard numbers which are actually visible. We also probably look at project awards, etc.
Yeah.
And when we meet many of these companies, so for example, all of us actually interact with a lot of corporates, and I would say 8 out of 10 companies in our interactions, anecdotally or even otherwise, and you can look at the fundraise, etc. Part of it is probably for debt repayment, I agree. But most of them are in a capex mode. I mean, whether they are doing brownfield, greenfield, acquisitions, etc. So all of them are indicating at a situation where they want to increase capacity, because for the last few years they've not done so. Last many years probably they've not done.
So you're satisfied with what you're seeing on ground as of now?
So the trends are good.
Trends are good.
It should probably interest rates is not something which we need to have. It's not a must-have. But if we get that, then that's something which will add on.
What about you, Rohit?
Yeah. I think that actually, you are seeing capex happening in the private sector. It may not be to the extent that which we kind of say that it's taking up the entire slack from, some slowdown in the government space that's being seen. But there are interesting areas where it's happening. So whether that's power is well known, right? That's one where everyone's investing in renewables, etc. You're seeing a lot of ESG type capex happening on the sustainability side. And finally, the manufacturing opportunity of India. That's a big deal. I think we've started seeing some small strides out there. Maybe the export story out there within manufacturing can pick up with, let's say, the global economy, including, say, the US markets or the US economy improving over the next few quarters and years. And that, I think, that will take that will get the private sector involved really on the capex side. When it comes to rates, really, like the others said, we're not necessarily in the camp which is calling for sharp interest rate cuts, but probably some of the action you're seeing on liquidity. So the CRR cut, for instance, I think that is starting to help out. And we didn't talk about it earlier, but I think financials is the elephant in the room, right? Large cap banks have done really nothing over the last few years.
Yeah.
And I think that gives an interesting catalyst out there too.
Absolutely. Just one round on global. Economists think Trump will do what he will do. India will not get hurt. It'll probably benefit. Agree? Disagree?
So I think, Trump this time around has a much better planned cabinet, unlike his first term, right? He obviously has Mr. Musk along with him. So I would definitely agree that what is going to happen with, say, Mexico, Canada and China would definitely benefit India to a larger extent. And there are multiple themes.
At the margin, benefit. And we'll talk about those themes in a bit, Taher.
Longer term benefit, but I think in the short run, we will probably also be impacted.
Rohit?
Yeah, I think there's going to be a lot of noise, and you're not sure whether some of it is posturing to kind of ensure that you get a better deal out of each trading partner.
Okay.
But I think there are opportunities and there are some risks as well.
So noisy 2025. So well, let's take a quick commercial break at this point, and then we'll come back and we'll dive into the real stuff, right? What are the themes to back? And that's what I think our viewers are going to be interested in as well. So let's take that break, get into that quick commercial break.
Welcome back. Well, we heard about what our fund managers expect for 2025, but let's zero it down a little bit more and let's get the top bets from there. Niket, you go first. Tell us what is that top bet for 2025?
So I think we do believe manufacturing will really play an important role as we get into 2025. So if you just look at the broader numbers, US has about 5.5% of the world's population, contributes to 25% of world GDP.
Okay.
Europe has about 4.5% of world population, contributes to 18% of world GDP. China has 17% of world population, contributes to 17% of GDP. India has 17.5% of world population, contributes only 3% of world GDP.
So that's where the opportunity.
So there has to be a significant movement, from mean reversion, right? And how do you do that? The only way you do that is manufacturing, and within manufacturing, you have to do more exports, right? That's how you get incremental GDP from 3% to 5 or 7% over a period of time. If you look at manufacturing theme per se, if you look at China and India, both of them started in 1970s at the same level. And China really took off from 2005 all the way to 2015 in a meaningful fashion. That's where globalization was being talked about. For India, this is probably the best time to happen because of anti-China sentiment that we are seeing right now. This is probably the best window to really accelerate on the manufacturing side. Also, if you look at India, is generally known for IT services, right? So if you look at globally, 20% is IT services or services export that we call, and 80% is merchandise export. So merchandise is far larger category than services.
Yeah.
In India, it's 60-40, 60 being services and 40 being merchandise. So I think the real move that the government has done in terms of PLI on the manufacturing, say mobile PLI, component PLI, which is likely to come announced shortly, all of them is actually moving in direction of ramping up the merchandise export from India. If you look at someone like, say, Apple this year is likely to do about $10 billion of sourcing from India. This used to be zero. If you look at India, in 2014, 78% of mobile phones was imported. Today, it's negative 25%, which means we export 25% to other countries, right? Thanks to PLI, obviously. So I do believe a lot of countries like China, if you look at Vietnam export is this year is about $120 billion. In 2013, Vietnam and India were at the same level. So we really need to do a lot of catch-up. And some of these PLI initiatives announced by the government are going to be quite handy as we go forward.
Just to get the number, you said 10% of the sourcing Apple does is from India.
No, $10 billion.
$10 billion.
$10 billion.
Right now. And
so if you look at
exports annually out of, which is made, which Apple sort of exports, merchandise exports is now, they've said that they want to get to about 25% of the overall sales, right?
That's correct. That's over a period of 5 years.
Right.
So which is, again, a very large size.
When we speak to most of these EMS companies, they all kind of are still with the Android ecosystem.
Correct.
Very few work with the Apple, actually.
Right.
So will that change, you think?
It will, right, with per capita. If you look at US per capita is $81,000. China's at $13,000. India's at $2,500.
Yeah.
It's 2.5. If it moves to 5,000, there's a large population willing to buy Apple phones in India itself. Right? So India will become de facto the second largest market for Apple in the next 5 years.
So for example, a Dixon, right, works with, phones are still the biggest segment. They work with all 5 Android clients.
Right.
So what next? I mean, they're getting into other components, etc. But within phones, Apple is a very high value segment.
Yeah. So if you look at mobile phone industry, is about 4 lakh crore. From a manufacturing standpoint, it's about 3 lakh crore worth of sales that they do.
Yeah.
Right? Of that 3 lakh crore, about 50% is semiconductor, which is 1.5 lakh crore. India virtually has no role to play, at least till FY28. Hopefully, the first foundry of Tata's will come and, we'll have some semiconductor from there. The balance 1.5 lakh crore is where the opportunity size lies, within the component manufacturing. Till now, if you look at prior to COVID, India was doing large amount of trading. 2020 to 24 was more of assembly. The first time we are now getting into manufacturing in a meaningful fashion because our value addition was only about 14-15%. Now we are really going to 50% because balance 50 is semiconductor, which you can't do it. So effectively, the first signs of manufacturing will be visible now with PLI of electronic component manufacturing going live. And you will also see that in other categories. You are seeing in compressors, right? There are companies who are now doing tie-up for compressors in India with 51% owned by an Indian guy and a 49% owned by an international guy. So I think all these moves will really play a big role to really change the unit economics of the way manufacturing changes in India.
Valuations, Niket?
It's quite punchy, but I think, in India, you have to pay, if you look at mid-cap itself, more than 65% of mid-cap are trading at more than 40 times 1 year forward earnings. So anything which is high quality and high growth is not going to come at 10p or 15p, right? It's going to be expensive in India.
Motilal on the private equity side, I think, is the only investor in Dixon. They put in $40 million back in the day, and that's the only money which I think Dixon has raised, right?
That's correct.
Ever in their life.
Yep.
And
apart from the IPO.
So apart from the IPO, do you need to do something? I mean, you have to find something very small. Is it possible, or you think it's
quite possible? I think if you identify some of these themes early in the cycle and play through the cycle, I think there is reasonable amount of money to be made. But you have to be ahead of the curve when you think about some of these newer themes. You have to identify which are those companies which have those capabilities. Like, for example, if you look at mobile phone, the real essence is display, camera modules, and to some extent plastic component manufacturing, which is quite relevant. So
just name one or two which you already own with full disclosure. I mean,
no, I think we own Shelly Engineering, which
is
is a public domain information.
And I think they work with Apple.
I don't know, but I think if you look at, they are very, very large on the plastic eco-component system.
Yes.
So if you look at mobile phone, there is a large amount of plastic component involved there.
Sure.
So we'll see how that plans.
And this is one of your recent entrants in 2024, I think.
Yes,
So.
it's been about 5 months old. Yeah.
All right.
Taher, do you want to talk about CDMO, which is a big sort of area of focus for you? What's the
I
thesis?
think this is obviously about companies in India essentially benefiting from the China plus one story, especially with regard to this whole space on small molecules as far as pharma is concerned, and even things like peptides, etc., which are coming into play. Especially there are a good number of companies which are involved in small molecules. Many of them have actually even started on the peptide molecule space, especially with regard to GLP-1. So small batches right now, but can probably pick up over a period of time. So I think that's one space that we clearly like. The other one that we are probably very excited about is on the domestic context is the power utilities and the power segment, but more particularly within the power value chain, the transmission portion of the power economy. And that's because we, as we all know, are in the midst of this massive change where we're looking forward to having at least 50% of our installed capacity being in renewables. This calls for a significant overhaul, upgradation, change in the transmission system, because you're now actually going to have a mix of different types of power, right? We're largely dependent on the transmission system was largely driven by coal-based power up until now, and now you're going to have a mixture of wind as well as solar and coal.
So transformers, companies which
So transformers, all kinds of equipment which are related to actually upgrading the whole transmission system.
The grid, basically.
The grid, because you are going to have instabilities induced because of this intervention of different kinds of power sources. So, and we've not done anything to the power transmission system in a very long period of time.
What kind of names? I mean, just to kind of
Talking about companies like Hitachi, GE Vernova, these are kind of guys who are going to, maybe even to some extent, even the likes of Siemens and ABB. Many of the multinationals probably will dominate here. There will also be the ancillaries, which are, as you mentioned, the transformer-related companies, where you have a fair number of Indian players as well. So I think that is the ecosystem that we like. We believe that that's something which is probably going to be a lot more durable. And this process is long enough, because you're talking about, even otherwise, you're talking about power capex being what in the vicinity of some $400 billion over the next 5 years in order to do everything. Generation as well as transmission. So I think that's a huge number, and we are crunched for time. We are talking about the next 5-6 years, because we have to accommodate that 500 gigawatt which comes out of wind and solar. So I think it's not a very long, duration theme, and at the same time, it is probably concentrated among a few players. So I think there'll be a few of them which will be really, really large beneficiaries.
No, that's interesting, particularly on Hitachi. I had visited the company around 15, 16 months ago, and they were talking about HVDC orders. Normally used to come once in 4-5 years.
Right.
Now they're expecting it once in every year. So it tells you the kind of,
We saw a couple of those actually come about in the past.
Indeed.
Yeah.
And, that's...
I think that's just the start, and we are probably going to see
many more.
Indeed.
as they come about.
All right, Rohit, what about you? Tell us what's the top bet for 2025? Which is
So mine is the most boring in the room, which is just the mean reversion factor of lower end consumption. And I think we've seen this, happen in a big way post-COVID, that the recovery has been extremely K-shaped, right? So you've seen the lower end, particularly, rural, has been impacted quite significantly.
It's a good day to talk about lower end consumption. Vishal Megamart had the Vishal listing. Go on, please. Sorry.
That's right. So, to that extent, we've also, if you go back, even something like two-wheelers, been doing badly from 2019 onwards, right? So it's even before COVID that space was probably struggling.
Yeah.
Now that it's been a while, there's been some change at the margin in terms of government policy, at least from the states coming out with some income transfers, etc. I think that is something which probably is driving a bit of growth out there, and just the fact that it's been poor for so many years, right? So just that, catch up, the sticker shock in terms of two-wheelers kind of, finally consumers are getting used to that. So I think that's one where there are probably...
Specifically, any sectors there?
I would say two-wheelers is an interesting one. Even within passenger vehicles, we've actually seen the small car segment has done nothing, right? It's all been SUVs, right? So potentially spaces like that. There's more tier 2 towns value retail. I mean, you did speak about
So you will be
Vishal, for
playing
example.
more OEMs, or will it be auto ancillaries when you're talking about this theme of two-wheelers as well as...
The good part is that in any of these themes, right, they're big enough to play both. You can do OEMs, you can do ANCs, and that's the great part, where it's not always so obvious. You'll find even potentially industrial names which are levered to those segments, and it's kind of hidden out there. You've got to do a bit more work to pick them, but that's something which can work out, right?
That's interesting. Mean reversion, lower end picking up, and premium maybe just sort of slacking off for a while. It's done very well.
That's
good
what.
Sugar rush over the last couple of years.
Right.
So we've got 3 ideas, but we've got more to go. 3 more, 4 more, 5 more. We'll do all of that. Let's take another quick commercial break here. Stay tuned. We are in conversation with the 3 market masters here. Themes for 2025 and ideas to bet on. Stay with us. Welcome back. You're with us here on this special market town hall, and we're ideating about what to put your money into in 2025 and beyond. And we've got 3 young star fund managers with us, and we're sort of bouncing around ideas. We got 1 round done earlier. Let's get to the next one. Niket, GLP-1 is a theme that you want to back, and there's a very specific opportunity.
Yeah.
Probably after, I think, Lipitor, perhaps the largest drug category in the world, eventually, right?
Yeah.
Talk to us about that and how to play it here.
So I think, obviously we've seen some large molecules like Revlimid in recent times, and GLP-1 obviously is probably the largest in mankind. We're now touching broadly about $50 billion worth of sale. There are still countries like Europe, India, some part of China, which still doesn't have, a GLP being launched at scale. So a lot of states within Europe and China don't have GLP-1s. And I think that clearly means that this particular molecule will continue to grow at very rapid pace, at least for the next 3 to 4 years. Now, within GLP, there are 2 major ones. There are 3, in fact, but 2 more relevant, which is liraglutide and semaglutide. Liraglutide is already off patent, but I think there's an exclusivity to one pharma guy till December 31st, which means from 1st Jan 2025, it gets off patent. And then there will be a lot of companies who will, try to tap on liraglutide. Sema gets into off patent next year in Canada, in Brazil. Canada is 2nd largest market after US for semaglutide. And so is Brazil, is probably the top 5 markets, which incrementally means that, again, there is significant size of opportunity for a large Indian pharma player, generic guys, to do first to file or, tap into that market. Now, there are multiple ways to play. One is obviously you play the API player. If there's an API player who will supply the API to the generic guys, that's still a very significant size of opportunity. The second is the generic guy itself, who decides to launch a generic version for Lira or Sema as and when, because the Sema gets into off-patent in 2032 in US, but other markets are still quite large, which incrementally means that there is a generic opportunity for the generic pharmaceutical players. Third is device manufacturers. Most of the GLP-1s are actually consumed through an auto-injector, which means that, and it's plastic in nature. So there is a significant amount of opportunity for device manufacturers because it cuts across all the players. Every player will need a device manufacturer. And there are a few Indian guys who have the capability to do. So I think these are the 3 ways you can really play this theme.
And you did mention Shelly does.
Yes.
Shelly's into that space, which
Yes.
you already have already backed, right?
Right.
And between API and sort of actual generic companies, is it a big if, or you think?
I would really go with the device manufacturer because it's quite critical and it cuts
Whoever
across.
makes it, the device is to be
Yeah,
there.
because everyone has to go to the device manufacturer effectively.
Okay. You, Taher, briefly mentioned CDMO, and I think I also heard GLP-1 earlier before you started talking about power transmission. Anything you want to add to what Niket said?
No, so I think there are a few companies which are also in the CDMO space, which are operating, trying to be end-to-end players in the spectrum. So Niket mentioned about certain companies which are in the specific buckets, but then there are some of them which are actually trying to do things end-to-end, and they're probably even enhancing their capabilities out there. We've seen a couple of new listings also which happened recently, which are in that area, and some of the existing companies as well. So I think that's the other part of the CDMO story which probably we
What
think
kind
will
of
probably
names? Just purely from an
we're
educational
looking at, let's say,
standpoint.
we have a probably reasonably large position in a company called Suvain. Suvain Pharma is essentially one of them. So I think that's one. And then there are a few others also which we have smaller positions in. But Suvain is the largest that we have, and it's one of our larger bets even in the focus fund. It's there in the public domain, so I don't have a problem in mentioning it.
Okay, all right, Rohit, what about you? I believe you're quite bullish on some of these real estate completion themes, real estate ancillary, so to call it.
Yeah.
Run us through that. I mean, what are the data points you're factoring in?
So we all know real estate, residential real estate has been in a good cycle, and it's been coming out of 21. That's been one space which is doing really well.
Yes.
Housing inventories have been low, so new launches have also been picking up over time. Really speaking, the new launches have picked up in a very big way in calendar year 22, 23, 24, and that's actually forecast to increase at a quick pace going forward as well. Now, if you go back to the previous real estate upcycle, right, I'm talking about the period between, loosely speaking, between 2004 and 2011, let's say.
Yeah.
You will recall that actually the peak kind of launches and peak purchases came somewhere in 2010 to 12, right? But then, if you recall, the peak of the completion plays, when you think of companies like tiles, ceramics, even consumer durables, etc., that actually came somewhere in 2015 to 17. Right, so I think that's a nice kind of space that one has. So those companies right now, the initial plays, like for example, housing pipes have done well because that's what's used in the initial phase of construction. But the later cycle, when you're kind of getting your home, when you're finally doing the finishing in terms of tiles, ceramics, and finally filling it up with whether durables or even other products like furniture, mattresses. I think there are interesting kind of plays out there. Which today they're not doing as well because clearly the homes are not completed yet, so you can't spend on them just yet.
The builders have put the checks in, but the homes, the keys have to be delivered.
Yeah.
So that is a space that you're looking at. Right?
Just talking about that theme, what about paints?
Yeah.
What's the view out there? Because that's been a sector.
So paints, we've been a bit selective out there. We've not kind of been across the board. It's not that we've kind of had huge holdings out there. We've been looking at it a little on a stock-specific basis, but clearly that space, like a lot of the consumer space, has had very high valuations in the previous decade, which unfortunately has led to new competition coming in. Right, when somebody sees that kind of market cap created by some of these top companies, that is an invitation for competition, and clearly large groups have been getting into that. So one wants to be a bit careful. Having said that, do you never want to get into that space? Probably not, because these are high quality companies, great, great barriers to entry, great track records, good managements. You want to look at when you want to get in, and frankly, we've been a bit selective, but it's not been a whole hog kind of jump into that space just yet.
Niket, consumer discretionary is something you mentioned, and I think Rohit was also talking about that. What kind of sort of ideas here within the discretionary
I would say
space?
jewelry is one space which is just holding up, right? Every category has gone through ups and downs this year. Jewelry continues to go at 25-30%. So that's a very good hiding space in the current market. And I think few of the value retailers, who have done quite well, Lights of Trend, who have done extremely well in this year. And we do expect a lot of newer businesses to get added to that existing, Zudio or West Side for as such.
Value seems to be like a common theme. Value retail and so the lower end of the segment, right?
Yeah.
I think Taher, you also like that space, and Rohit, you also mentioned that. So that space should do well. Okay, what we'll do is we have a couple of our own sectors that we want to ask, which I didn't hear quick commerce at all. That's been the big winner. I mean, Motilal Oswal, of course, is a big backer across all three companies, right? Yeah. So we'll talk about that. But let's take another quick commercial break. What we'll do is we'll come back and open it up on the floor as well. So, the audience, the live audience which is here, will have an opportunity to take questions to all three guests here. So stay with us. We're right back.
Welcome back. Well, we got all the top themes that we are looking at in 2025. But as promised, we're going to open up the discussion to the audience as well. They've got some queries, and my colleague Yash is in there. He's going to be pulling up a couple of them. Yash, over to you.
Well, thank you, Nigel. Thank you, Prashant. And of course, the Market Starcast for that quality discussion. And to make it more interesting, we've got very curious finance minds from colleges across the city. Let's open the floor to those questions. So if you could start, of course, introduce yourself and then go ahead with the question.
Okay, so good evening all. I'm assistant professor in Narsimunji College, myself Gopal Krishna Chudnekar.
Welcome.
Okay, my question is that now the young people from India, they are investing a lot in equity market, but at the same time it is creating issue for the deposits in the bank. So how do you see this issue, okay, specifically for the banking sector and investment in banking sector both? So that is my question.
I'll take that. So actually, there's a bit of a myth that the money which goes to equity markets moves out of the banking system. It doesn't move out of the banking system.
Okay.
Simple example, if I buy a share, you sell it, if you get capital because of you sold the share, that money goes to your bank account. And it debits from my account, goes to your account. So whenever equity market tends to blossom, that doesn't mean that deposits are going to get impacted because the money only remains in the banking system, right? Money doesn't move. The only time the money moves out of the banking system in case if the FIS sells out and moves out, that's the only time. Otherwise, yeah, the color might change. Instead of CASA or term deposit, that can change, but largely the money doesn't move out of the banking system.
And what is...
And also just to add that, what actually drives deposit creation is actually credit creation. So if you're going to have a weak credit cycle, then that's also going to be an additional headache as far as deposit creation is going to be concerned. Because once you start developing credit, then it actually starts accumulating as deposits in the system in one account or the other. So I think partly, yes, you're right that maybe some transfers do happen from one account to another. But by and large, I think to ensure that if you have a good deposit growth, you need to probably ensure that the credit cycle is maintained. We've seen a little bit of slippage as far as the credit cycle in India is concerned. And but we've also, at the same time, starting to see that now deposit growth and credit growth are actually, moving in tandem. Yep. Yes. Earlier, deposit growth was significantly lagging credit growth. So I think that's a good sign in a way. And hopefully it will probably start to develop a little more strongly in the course of 2025.
And I would just add actually that regulation has been quite proactive in that sense, seeing some of the issues that the US banking system, for example, saw in early 2023 with deposits leaving some of these online banks, right? I think so RBI had been quite, specific with banks in terms of asking them to look at loan to deposit ratios, because that's certainly important from a overall financial stability perspective.
Okay, let's take a few more questions. Yash?
Yes, we'll take another question from the front row itself. Ma'am, you had a question. Please go ahead.
Hi, I'm Nabanita. I am analyst working at Anurati Wealth. My question is, this has been the year of value. And do we expect a mean reversion? Do we expect growth to come in play in the coming year?
So I would like to think so probably that you will probably see a improvement in the growth part of the market as well during the course of 2025. Will it come at the cost of value? I'm not too sure, because you are probably going to see. So there are some parts of the industrial economy, and we talked a little bit about that in the last in the last hour. Those are also looking reasonably strong. And if we probably were to see the combination of government capex and private capex continuing, I think value will also find support. But along the way, I think the one important trigger, which once again I go back, probably will drive value to make a comeback, is probably the direction of interest rates. We're not necessarily looking forward to a very deep cut in interest rates, but even if we get a shallow cut, a shallow cycle downwards, I think that'll help the cause. Rohit talked about, the recovery as far as the consumption space is concerned, especially as far as value consumption is concerned. I think many of those companies are actually growth oriented. So if they make a comeback, probably the growth portion of the market starts looking better.
Right.
So there is that anticipation that some part of it should unfold in 2025.
Yash?
You want to probably add something?
Can I just add?
Yeah. Yes, please.
So on this value versus quality versus growth debate, right? So we at SBI Mutual Fund run a quant model, right, which runs different factor indices. And when any of those hits an extreme, either on the upside or the downside, that's when we go back and rebalance. So earlier this year, somewhere around April, our model was actually showing that quality had hit the bottom in terms of our lower band threshold. So that's when what we do is we rebalance all the factors that we're looking at, quality, growth, value, momentum. We rebalance them all to an equal 25%. And that actually happened earlier this year. So, to that extent, we are kind of, while we don't try to predict which style is going to do the best, whether it's going to be quality, growth or whatever, but we do think that, it's a good time to have rebalanced, away from value to an equal right now.
Okay, we have another question from the gentleman at the back. If you could just introduce yourself.
So hi, my name is Sami and I'm a student at this moment. So I have a question regarding the US markets, to be specific. So after the US Donald Trump's victory, it has been a euphoric moment for the markets, and specifically if we look at the FANG and the Nasdaq, it has given a phenomenal return. So, and even after the news of the SoftBank putting in around more $100 billion, it is about to give more returns. So, do you see any near-time corrections, and has the decoupling effect really happened with the Indian markets? Because we do not see the such run-up in the IT sector here, even after the bolstering of the dollar.
Okay.
Yeah, so I think if you look at tech itself, I think the reason why tech did very well the day Donald Trump was announced the winner, the next day in Indian markets, the largest gainer was a tech, because I think he's already articulated the tax cut that he plans to do. Whenever there's a tax cut in US enterprises, there's significant amount of free cash flow which is left in their hand, which typically tends to go towards IT services spend. For US companies, IT services spend is like a capex. For Indian, it's like OPEX. We don't spend like billions of dollars on IT services. But these guys, because they have global operations, they do spend billions of dollars on IT. And hence, I think with tax cuts happening, tech should do quite well in US for next year. And it can be the sector for the year.
Okay. Maybe take one more, Yash? I mean, if you can. Just a very short one, please.
If anyone who has a question can raise their hands, please.
Good evening, everyone. I am Dilsha Chodasama and I'm preparing for my CFA level 1. So my question to Niket sir is about the QGLP approach and how does it ensure that the investment process remains consistent and the returns are on par with the benchmark even during the high periods of market volatility?
Yeah, so I think QGLP simply stands for quality, which is not only quality of earnings, but quality of management, right? And there are a lot of filters on it. One is return ratios, capital allocation that the company does, cash flow analysis of that businesses. So quality of business and quality of management is quite important. G stands for growth. Fundamentally, we like to buy businesses with at least 25% plus growth. And hence, we fundamentally believe that whatever is the earnings growth, assuming multiple remaining the same, should be the return of the stock price over the next 1 year. So if a business is growing at 25%, stock price should give you a 25% return, assuming P multiples remaining same. L stands for longevity of the growth, which essentially means that you buy businesses which are a little more structural in nature, say food delivery business or multiple other businesses. So we don't like to buy businesses which are cyclical in nature, like the metal business. It's quite difficult to predict next year what steel prices are going to be, right? So L stands for longevity of that growth, and P stands for price, which is buying them at the right valuation, which in current environment is quite difficult.
And that's where the magic happens, right?
Yeah, that's where
all of them.
So you have to buy it early. Yeah. You have to predict earnings early. And if your prediction of earnings is sharper, then you get stocks at a lower multiple.
Well, that gets us to a nice close on this very, very wonderful discussion. Niket, Taher and Rohit, great to have all of you here. I want to thank the audience as well for being a wonderful listener and asking all those intelligent questions. Yash, thank you very much wherever you are. That's it on this Market Town Hall special from all of us here. Goodbye.